Okay, so you want to own a corner shop. The neighborhood institution, the place that never closes when everything else does. The shop where 3 generations of the same family have bought their morning paper, their emergency pint of milk, their lottery ticket, their packet of biscuits on the way home from work. You picture the simplicity of it. Stock the shelves, open the door, take the money. People always need bread. People always need milk. People always need something at 7 in the evening when the supermarket has already locked its doors and the online delivery slot is 4 hours away. The demand is constant. The concept is simple. Surely the money follows. Here is what you do not see from the other side of the counter. The delivery driver who arrived at 5:45 in the morning with a consignment that included 12 units of a product you did not order and was missing 30 units of a product you desperately needed before the morning rush. The electricity bill that arrived in the same week, the chilled cabinet compressor failed, and you lost 240 pounds of refrigerated stock overnight. The card payment system that went down on a Saturday afternoon during the busiest 4 hours of your trading week. The tobacco gantry that requires a licensed storage compliance check you did not know existed until the council inspector walked through the door. The family 3 streets over who opened a competing shop 6 months after you invested your savings in the refit that was supposed to make yours the best in the area. The British corner shop, or convenience store as the industry now predominantly describes it, is one of the most culturally embedded and economically misunderstood retail businesses in the country. On the outside, it looks like simplicity itself. On the inside, it looks like a business operating on margins so thin that the difference between a profitable week and a loss-making one is a single supplier price change, a single equipment failure, or a single shift of customer habit that nobody saw coming. Some corner shops are quietly excellent businesses that have funded family wealth across multiple generations, paid for university educations, and provided their owners with a degree of financial independence that employment could never have delivered. Some are running on the personal labor subsidy of an owner working 80 hours a week at an effective hourly rate that falls below the national living wage when the numbers are honestly calculated. And some have consumed the life savings of people who understood retail instinctively, but understood the economics of this specific retail format not nearly well enough. By the end of this, you will understand exactly which outcome you are building toward and why. What a corner shop actually is. Before we talk about money, we need to establish what a British corner shop actually is as a business in 2025, because the format has changed more dramatically in the past 30 years than the cultural image of it suggests. The independent corner shop in its traditional form is exactly what the name implies. A small retail unit, typically between 400 and 1,200 square feet of selling space, stocking a range of everyday convenience products, located in a residential neighborhood, and operated by an owner who is frequently present behind the counter. These are the shops that built the reputation of the format, that are woven into the social fabric of British towns and cities, and that have historically been disproportionately owned and operated by South Asian families, particularly those of Indian, Pakistani, and Bangladeshi heritage, who identified the opportunity in the format decades before the major supermarket chains understood what convenience retail could become. The Symbol Group affiliated convenience store is a different but closely related model. Stores affiliated with wholesale and symbol groups such as Spar, Nisa, Premier, Cost Cutter, or Best One operate as independently owned businesses but trade under a group brand, access centrally negotiated supplier terms, and benefit from joint marketing and promotional support. The owner retains independence and keeps the profits, but operates within a framework that provides better buying power than a purely independent operator could access alone. The forecourt convenience store, attached to a petrol station, is a third variant with a specific customer profile built around the motorist making a convenience purchase alongside a fuel transaction. The economics of this format are significantly different from the neighborhood corner shop because the fuel revenue creates a separate and substantial income stream. The franchise convenience store, operated under a franchise agreement with a major symbol group or increasingly with the convenience arms of major supermarket chains, represents the most structured and, in some ways, most financially predictable entry point into the format, but also the one with the most constraints on the operator's commercial freedom. This conversation focuses on the independent and symbol-affiliated neighborhood convenience store, the format most people mean when they say corner shop, and the one where the economics are most revealing about the genuine opportunities and genuine risks of the business. The cost of opening the door. The acquisition cost of a corner shop varies more widely than most people entering the market expect, and understanding what the purchase price actually includes is the first critical test of financial literacy in this business. When a corner shop is sold as a going concern, the purchase price typically includes the value of the lease on the premises, the goodwill of the established trade, the shop fixtures and fittings, and the stock at valuation. What it does not include is the freehold of the building, which in the vast majority of corner shop situations is owned by a private landlord or a property company rather than the business operator. A small corner shop in a secondary residential location in a northern English town might be acquired for £15,000 to £50,000. A well-established shop with strong weekly turnover in a prosperous suburban area of a major city might command £100,000 to £250,000. The goodwill component of that price, the premium paid for the established customer base and trading reputation, is the most speculative element because it is based entirely on the assumption that the customers who came for the previous owner will continue coming for the new one. That assumption is not guaranteed. The lease is the most consequential inherited commitment in any corner shop acquisition. A lease with 3 years remaining on a 10-year term in a location with a landlord who has commercial development ambitions for the site is a very different proposition from a lease with 8 years remaining at a fixed rent in a stable residential location. The legal advice required to properly assess a commercial lease before signing a business purchase agreement is not optional. It is the minimum due diligence that the size of the financial commitment demands. Refit costs are where the gap between the acquisition price and the total capital required to open the shop frequently catches new owners completely unprepared. A shop acquired in good condition might require minimal initial investment beyond stock. A shop acquired at a lower price precisely because it needs work might require £20,000 to £80,000 in refrigeration upgrades, shelving replacement, electrical work to meet current standards, security installation, flooring, and decorative refurbishment before it is trading at the standard the modern convenience customer expects. The refrigeration requirement deserves particular attention because it is both the most capital-intensive equipment category and the most operationally critical. Modern convenience retail is heavily weighted toward chilled and fresh categories, which have the best margins in the format, but require reliable refrigerated display at continuous cost. A bank of commercial chilled cabinets costs £5,000 to £15,000 per unit to purchase new. A chilled cabinet that fails overnight during a warm summer causes not just the repair cost, but the stock loss of everything it was holding. Refrigeration maintenance contracts are not optional luxuries. They are insurance against a category of loss that can materially damage a week's trading. Total capital required to open a corner shop, including acquisition, refit, initial stock, equipment, working capital reserve, licensing, and professional fees, realistically runs from £40,000 at the very low end for a minimal operation in a favorable location to £250,000 for a properly resourced shop in a competitive urban market. The margin reality that changes everything. Point d'honneur. Here is the number that reframes every other conversation about corner shop economics, and it is the one that people who have never worked in retail consistently underestimate. The gross margin on a corner shop's product mix is typically between 18 and 28% of sales revenue. That means that for every pound a customer spends in the shop, between 72 and 82 pence goes straight back out in the cost of the goods. The shop keeps between 18 and 28 pence to cover rent, wages, utilities, equipment, insurance, and everything else before generating any profit. This margin structure is not a peculiarity of badly run shops. It is the structural reality of convenience retail as a format. The products that drive footfall and purchase frequency in a corner shop: cigarettes and tobacco, newspapers and magazines, soft drinks, confectionery, alcohol, and basic grocery staples, are products whose retail prices are either regulated, price-marked, or subject to intense competitive pressure from supermarkets and discounters. The margin on a packet of cigarettes is approximately 6 to 8%. The margin on a national newspaper is approximately 25% on the cover price, but the volume is declining every year. The margin on a price-marked can of a major soft drink brand is approximately 15 to 18%. The categories that carry better margins: food to go, fresh food, own label grocery, premium confectionery, local and artisan products, are also the categories that require more investment, more skill in buying and ranging, more discipline in waste management, and more active category management than the traditional corner shop model was built to deliver. This margin reality is why the corner shop business is fundamentally a volume and cost control business rather than a margin improvement business. The path to profitability is not primarily about finding higher margin products to sell. It is about generating enough volume at the available margins to cover a cost base that has to be managed with absolute precision, because there is almost no buffer between income and cost. The cost structure that never stops. The fixed and semi-fixed costs of a corner shop are modest in absolute terms compared to larger retail formats, but are substantial relative to the gross profit the trading generates. And they arrive with the regularity and indifference to your trading week that characterizes every fixed cost in every business. Rent is typically the largest single fixed cost. A corner shop lease in a secondary residential location might run £8,000 to £18,000 per year. In a primary location in a prosperous urban area, that figure can reach £30,000 to £60,000. Rent reviews built into commercial leases, typically every 3 to 5 years, adjust the rent to current market levels regardless of whether the shop's trading performance justifies the increase. A rent review that pushes annual rent from £15,000 to £22,000 in a market where turnover has been flat for 2 years is not a theoretical risk. It is a recurring feature of commercial retail tenancy in Britain. Utilities for a corner shop are disproportionately significant relative to the size of the premises because of the refrigeration load. Chilled and frozen cabinets running continuously, 24 hours a day, 365 days a year, are significant electricity consumers. A shop with a standard complement of chilled cabinets can spend £8,000 to £18,000 per year on electricity alone. The energy price volatility of 2021 to 2023 was not an abstract macroeconomic event for corner shop owners. It was a line item that in some cases doubled or tripled within a single contract renewal period, with no mechanism to recover the increase through margin, because the retail prices of most core products are either price-marked or constrained by competitive pressure. Labor is the third major cost category, and it is the one that reveals the most about how corner shops actually function financially. The typical small corner shop does not employ enough staff to run entirely on employed labor at market wages. The economics do not work. A shop generating £100,000 of annual turnover at a 22% gross margin produces £22,000 of gross profit. If the rent is $12,000 and utilities are $10,000, the gross profit is entirely consumed before a single employee, wage, insurance payment, or owner drawing is accounted for. The model that makes the corner shop financially viable in most cases is owner-operator labor. The owner works the shop, frequently alongside family members, at an effective hourly rate that is not paid as wages, but is instead embedded in whatever the business generates after costs. This is not exploitation in any legal sense. It is the economic structure of small retail that has sustained the format for generations. It is also the reason why the corner shop must be understood as a lifestyle business, a business whose financial returns cannot be separated from the labor contribution of the people running it, rather than as a conventional investment that can be assessed purely on financial returns to capital. The supplier relationship and the symbol group question. A corner shop owner's single most important commercial relationship is with their wholesale supplier, and the terms of that relationship determine the margin available on a significant proportion of what the shop sells. An independent shop buying on the open wholesale market, shopping around for the best price on individual product categories without a formal supplier relationship, is likely paying higher unit costs than a shop affiliated with a symbol group that has negotiated volume terms across thousands of member stores. The price difference on a delivered case of ambient grocery products between a fully independent buyer and a symbol group member can be 3 to 8%. On products generating an 18% gross margin to begin with, a 5% buying advantage is commercially very significant. Symbol group membership comes with trade-offs. The group may require a minimum weekly purchase commitment from its wholesale operation. It may require the shop to stock a defined range of group own-label products and to participate in promotional programs that the operator has not individually chosen. It may require the shop to maintain a specific retail standard and to use the group's branded fascia. The operator retains ownership of the business and keeps the profits, but operates within a commercial framework that constrains some elements of their buying and ranging freedom. The question of whether to join a symbol group and which group to join is one of the most consequential commercial decisions a corner shop owner makes, and it is one that should be made after genuinely comparing the buying terms, the support offer, the promotional program, and the contractual obligations of multiple groups, rather than accepting the first approach made by a group's development representative. The tobacco and lottery complexity. Two product categories in the corner shop create specific operational and financial complexity that neither is captured in the simple margin conversation. Tobacco and cigarettes remain a significant footfall driver for corner shops despite decades of declining consumption, plain packaging legislation, and the continued upward trajectory of duty that makes tobacco products increasingly expensive. The regulatory framework around tobacco retail is extensive. A retailer selling tobacco products must maintain a closed gantry system that meets specific display regulations. Age verification procedures must be documented and staff trained. Sale to under 18s carries criminal penalties. The margin on tobacco is low, typically 6 to 8% of the retail price. But the footfall value of a tobacco purchase is high because customers buying cigarettes frequently add other purchases. Losing tobacco sales entirely to a competitor across the street is not simply losing the margin on cigarettes. It is potentially losing the basket value of every associated purchase. The National Lottery Retail Terminal represents a different category of complexity. A lottery terminal in a corner shop generates a retail commission of approximately 5 to 6% on ticket sales, plus a prize payment commission when customers claim wins. For a busy shop with a loyal lottery-playing customer base, annual lottery commission might run £3,000 to £8,000. The lottery terminal also drives footfall on draw days because customers come specifically to buy tickets and frequently purchase other items in the same visit. The cost of the terminal is managed by Camelot, the lottery operator, but the space it occupies, the staff time it requires for customer service, and the cash management it creates are real operational costs that sit on the shop side of the relationship. The supermarket and the discounter, the competitive pressure that never relents. The competitive landscape facing the British corner shop has changed more dramatically in the past 20 years than the cultural image of the format suggests. And understanding that landscape honestly is essential to understanding the economics. The major supermarket chains, Tesco, Sainsbury's, and Morrisons, all operate convenience format stores under sub-brands Tesco Express, Sainsbury's Local, and Morrisons Daily that directly compete for the convenience shopping mission that the corner shop has historically served. These formats operate in residential neighborhoods, are open extended hours, and have buying power that no independent operator can match. When a Tesco Express opens within 200 meters of an established independent corner shop, the independent loses a portion of its trade. The question is how much, and the honest answer varies enormously depending on the quality, the ranging, the service, and the community relationships the independent has built. The discount grocery retailers, Aldi and Lidl, have reshaped British grocery shopping habits in ways that affect convenience retail indirectly. Consumers who do their main grocery shop at Aldi or Lidl have lower grocery costs overall, which gives them less incentive to trade price for convenience at a corner shop. The convenience premium, the extra amount a customer will pay per unit for the convenience of proximity and extended hours, has been under pressure as the price differential between discount grocery and convenience retail has widened. The shops that have defended their position against this competitive pressure most successfully have done so not by trying to compete on price, which is structurally impossible given the margin and buying power differential, but by competing on the things that a large format retailer cannot replicate. Genuine service from a person who knows their customers by name. A product range calibrated to the specific tastes and needs of the immediate neighborhood, rather than a centrally determined planogram. Extended opening hours beyond what the large format stores offer. A community presence that is about more than retail transactions. Two scenarios. The honest numbers, the good year. You own a well-located corner shop in a prosperous residential suburb. Weekly turnover runs £14,000. Annual turnover £728,000. At a blended gross margin of 24%. Gross profit is £174,000. Rent is $18,000. Utilities $14,000. One full-time employed member of staff at $24,000, including employer national insurance. Accounting and professional fees $3,000. Insurance $2,500. Maintenance and sundry costs $4,000. Total non-owner costs $65,500. Gross profit after costs £108,500. From this you fund your own labor. If you are working 50 hours per week across 50 weeks, that is 2,500 hours of your time per year. At £40 per hour as a reasonable market rate for a skilled retail manager, your labor contribution is worth £100,000. Net financial return after imputed labor cost, £8,500. The shop is viable. You are working very hard for a reasonable living rather than a spectacular financial return on capital. The bad year? The Tesco Express that opened 8 months ago on the main road has taken an estimated 15% of your ambient grocery trade. A water leak from the flat above during January required emergency repairs and caused 3 days of partial closure, costing you £11,000 in lost sales and repair costs. The electricity contract renewal in March increased your annual bill by £4,200. Weekly turnover has fallen to £11,500. Annual turnover, $598,000. Gross profit at 23% blended margin, $137,000. Total non-owner costs remain broadly similar at $64,000. Gross profit after costs, $73,000. Against your labor contribution of £100,000, the business is generating less than the value of your own time. You are effectively paying to work. Many corner shop owners in exactly this situation continue operating because the alternative, finding employment that pays equivalently for their skills and their hours, does not exist in their local market. Some close. Some sell for less than they paid. What the shops that thrive do differently, the corner shops that build genuine financial value over time and that sustain family wealth across generations, have almost uniformly done several things that their less successful counterparts have not. They invested in understanding their specific customer base, rather than stocking what the wholesale catalog suggested they should stock. A shop serving a large South Asian community, or a large Polish community, or a neighborhood with a high proportion of young professionals, or an area with a significant elderly population, has a specific product range opportunity that a generically stocked shop cannot capture. The shops that captured that opportunity built a customer loyalty that the Tesco Express across the road cannot easily replicate, because the Tesco Express is stocked from a central planogram that does not know what your neighborhood actually wants. They treated food to go as a genuine business category rather than an afterthought. The margin on freshly prepared food, on hot drinks, on sandwiches and rolls made on the premises is substantially better than the margin on ambient grocery. A corner shop that invested in a proper food-to-go offer, that maintained the hygiene standards it requires, and that built a morning and lunchtime food mission into the customer relationship. Built a revenue stream that the supermarket convenience format struggles to match at the same quality level. They manage their own hours, honestly. The owner who works 80 hours per week in a shop at generating a return that only justifies 60 hours is subsidizing the business with their own time, in a way that is invisible in the accounts, but very real in the life. The shops with the best long-term economics are the ones where the owners made clear-eyed decisions about the relationship between their hours and the business's financial performance, rather than working harder as the default response to every financial pressure. The howdy honest conclusion. The British corner shop is not a simple business. It is a business operating on thin margins in a competitive environment, where the structural forces are not moving in its favor, where the labor model depends on owner commitment that cannot easily be monetized, and where the difference between a viable operation and an unviable one is frequently a single competitor opening, a single contract renewal, or a single equipment failure in the wrong week. The shops that endure are the ones whose owners understood from the beginning that the corner shop's competitive advantage is not price and it is not range. It is community. It is the knowledge of who lives in the 3 streets around the shop and what they need on a Tuesday evening. It is the service that a person provides that a self-checkout machine cannot. It is the trust that is built one transaction at a time over years, and that makes the shop the first choice rather than the last resort. That advantage is real and it is durable. But it has to be built deliberately on a financial foundation that is managed with the same rigor that any business in a thin margin, high volume category demands. The warmth of the corner shop and the discipline of the corner shop economics are not in conflict. They are both necessary. The shops that treated the warmth as the business and ignored the economics are the ones that are gone. The ones that built both are the ones still open at 7 on a Sunday evening when everyone else is closed. If you want to understand British business, British money, and the real economics behind the institutions that shape everyday life in this country, the Money Framework British channel is where that conversation lives. Subscribe to Money Framework British, turn on notifications, and join us for the next breakdown. Because the most important financial lessons are never the obvious ones. They are always the ones hiding in plain sight behind the counter.